guidance is the guidance, and you always have to wait and see how it plays out.
That's what the legendary Frank Slootman, one of the most successful businessmen on earth, told me when he wanted to explain why I was wrong to overweight Snowflake's forecast as a way to value the stock. That was all the way back in November 2022. As he saw it, the forecast is just a number, and in a skittish market, that number can have a lot more impact than it should. Welcome back to a very skittish market, one where investors aren't interested in how you did. They only care about what you say you'll do in the future. So if you aren't offering a healthy, sharply better than expected forecast, well, your stock is instant roadkill. This morning, Harley Finkelstein, president of Shopify, came on Squawk on the Street, told us not to worry about his guidance, which calls for a slight degradation in gross margin after a truly blowout quarter. Does that make sense? Depends. The CFO, Jeff Hoffmeister, explained on the conference call that Shopify's expected 50 basis point gross margin decline largely comes down to, and I'm going to quote here, the expected growth of our lower margin payments business and lower revenue contribution from a high margin non-cash partnership that will have fully amortized, end quote. To me, that's a hangnail, barely worth noticing. To the market, though, it was a disaster that caused Shopify to lose nearly 20% of its value in a single session. Uber reported a fantastic quarter, showing strength across the board, but for some attenuated reason. Management guided for gross bookings of $38.75 billion to $40.25 billion, ever so slightly weaker than expected. That was enough to knock almost 6% off the stock. Kind of ridiculous given how hard it was to figure out why Uber even gave such a cautious forecast. But Slootman's law, the guidance is the guidance. So management must know something or they wouldn't be so circumspect, or at least that's how Wall Street sees it. We saw the same thing with Upstart, the artificial intelligence-based lender that used to be a market darling before the stock peaked at the end of 2021. Upstart had a terrific quarter, but the outlook was suboptimal, and the stock dropped 5.5%. Is that fair? Look, it's just a number, but the number means something in a market that's sensing a slowdown. It's not just today. Datadog, a truly terrific enterprise software company that does digital infrastructure monitoring analytics, saw its stock fall from 127 to 112 yesterday because, well, its second quarter earnings guidance was a penny short. Stock rebounded 117 today as cooler heads prevailed, but it's still way down from its pre-quarter highs. But you know what didn't bounce back today? Disney. Now, here's a company that reported a terrific quarter yesterday. In a vacuum, it would have sent the stock much higher. However, there's no such thing as a vacuum on Wall Street. Disney CFO Hugh Johnston gave us a Frank Slootman bomb of a forecast. Quote, as it relates to demand, while consumers continue to travel in record numbers, hey, so far so good, and we are still seeing healthy demand, I don't like that word still, we are seeing some evidence of a global moderation from peak post-COVID travel. That's what took Disney from 116 to 105 yesterday. No real rebound today. Now, there are times when I think we need to take all these forecasts with a grain of salt. If the Fed starts cutting rates, I could see buying some of these stocks, although they're not the first ones I'd reach for in that scenario. I would prefer to go, say, for a builder's first source, a home building supplier with a stock that fell 19% yesterday on soft guidance. That one should react immediately to a rate cut. But either way, you need to understand in this market, even though the guidance is just the guidance, right now, the guidance is all that matters. Dead Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.